Before we dive in, please remember that this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation is not a substitute for professional advice. The insurance landscape can be complex and varies by state, so you should always consult with a qualified professional to discuss your individual needs. Alright, let's get into it. You are probably overpaying for car insurance. I'm not just saying that to get your attention. I'm saying it because the data backs it up. A recent industry report revealed that nearly half of all American drivers haven't shopped for new auto insurance in the last 3 years. Think about that. In a world where prices for everything are changing constantly, half the country is just letting their policy auto-renew, year after year, often with a sneaky little price hike each time. This isn't just a few dollars. For millions of people, it's the equivalent of setting a $500 bill on fire every single year. Sometimes it's over $1,000. And why don't we shop around? Because it's a nightmare. Feels like a part-time job we never signed up for. You fill out one form, and suddenly your phone starts blowing up with calls from agents you've never heard of. You try to compare quotes online, and it's like comparing apples to oranges to, I don't know, a lawnmower. Every company presents its information differently. They use confusing terms like bodily injury liability, PIP, uninsured motorist coverage. It's an alphabet soup designed to make your head spin until you just give up and stick with what you know, even if you're getting fleeced. But here's the truth the insurance industry doesn't want you to know. It doesn't have to be this way. There is a system, a simple, repeatable process that allows you to take back control, understand exactly what you're buying, and find the best possible rate for the coverage you actually need. And today, I'm giving you the keys to that system. We are going to break down the 5 most important things you need to know before you even get a single quote. Getting this right is the difference between saving $50 and saving $500. It's the difference between having a policy that protects your family and your assets, and having one that leaves you dangerously exposed when disaster strikes. We're going to talk about the secret number that insurers care about more than your driving record. We're going to expose the most common coverage mistake that can lead to financial ruin after a major accident. And I'll even show you the one document, sitting in your email or glove box right now, that holds the cheat codes to this entire game. So let's start with the biggest bombshell, the one that makes people's jaws drop when they first hear it. It's the factor that can swing your insurance rates by hundreds of dollars, and it has absolutely nothing to do with how many speeding tickets you have or how safely you drive. The first thing you need to know is that your credit score is silently shaping your insurance premium. Now, before you click away thinking, my credit is fine, or that's not fair, you need to understand what's really happening. Insurance companies don't use your regular FICO score, the one you check before getting a mortgage or a car loan. Instead, they use something called a credit-based insurance score. It's a different algorithm. It pulls data from your credit report, things like your payment history, your level of debt, how long you've had credit, and uses it to predict how likely you are to file a claim. I know it sounds crazy. What does paying your Visa bill on time have to do with you running a red light? Well, decades of data analysis by the insurance industry have shown a strong correlation. People who are more responsible with their finances also tend to be more responsible behind the wheel. They're more likely to do regular maintenance on their car, less likely to take risks, and therefore less likely to cost the insurance company money. Whether we agree with it or not, it's the reality in almost every state. In fact, a poor credit-based insurance score can increase your premiums more than a drunk driving conviction in some cases. That is not an exaggeration. We're talking about a potential difference of hundreds, even over $1,000 a year, just based on this one hidden number. Now, a few states like California, Hawaii, and Massachusetts have banned this practice, but for the vast majority of the country, this is a major pricing factor. So what can you do about it? First, know that you have the right to your information. You can get a free copy of your credit report from all 3 major bureaus, Equifax, Experian, and TransUnion, every single year. Go through it with a fine-toothed comb. A simple error, like a debt that isn't yours or a late payment that was actually on time, could be costing you a fortune. Dispute any errors immediately. Second, focus on the fundamentals of good credit hygiene. Pay every single bill on time every time. Keep your credit card balances low. And avoid opening a bunch of new credit accounts right before you shop for insurance. Improving this score won't just help you with insurance. It will save you money on every major financial decision in your life. It is the single most powerful lever you can pull to lower your rates before you even speak to an agent. Okay, that brings us to the second and arguably the most practical thing you must know before comparing quotes: how to read your current policy. Specifically, a document called the declarations page. This is your cheat sheet. It's the 1 or 2 page summary at the front of your insurance policy that breaks down exactly what you're paying for. If you don't have a physical copy, log into your insurer's website or app right now and download it. Oh wait, got it? Good. Because understanding this document is like being given the answers to the test. When you start shopping for new quotes, you need to be comparing apples to apples, and this page is your recipe. Let's break down the most important parts. Look for a section called Liability Coverage. You'll probably see 3 numbers separated by slashes, like 25/50/25 or 100/300/100. This is the absolute core of your policy. It's the coverage that pays for the damage you do to other people if you cause an accident. Let's use 100/300/100 as our example. The first number, 100, means your policy will pay up to $100,000 for any single person's medical bills in the other car. The second number, 300, is the total maximum your policy will pay for all medical bills for everyone in the other car combined, so $300,000. The third number, 100, means your policy will pay up to $100,000 for damage to their car and any other property you hit, like a fence or a mailbox. Now, here is the critical part. Many people just have the state-mandated minimum liability coverage to be legal. This is one of the most dangerous financial mistakes you can make. State minimums are terrifyingly low. In some states, property damage liability is as low as $5,000. Think about that. The average new car in America costs over $48,000. If you have $5,000 in coverage and you total someone's brand new pickup truck, where do you think the other $43,000 comes from? Comes from you. They will sue you. They will garnish your wages. They will go after your house. For the sake of a few extra dollars a month, you could risk everything you've ever worked for. Your liability limits are not the place to be cheap. Next on your declarations page, you'll see collision and comprehensive coverage. This is the coverage that fixes your car. Collision is simple. It pays to repair your car if you collide with something, whether it's another car or a pole. Comprehensive covers almost everything else: theft, vandalism, fire, hail, a deer jumping out in front of you. Next to each of these, you'll see a deductible like $500 or $1,000. The deductible is the amount you have to pay out of pocket before the insurance company pays a dime. So if you have a $1,000 deductible and do $5,000 worth of damage, you pay the first $1,000, and the insurance company pays the other $4,000. A higher deductible means a lower monthly premium, but it also means more cash you need on hand if something happens. This is a personal choice, but never choose a deductible that you couldn't easily pay tomorrow without going into debt. Finally, look for uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. This might be the most underrated and important coverage you can buy. This protects you and your family if you are hit by someone who has no insurance or not enough insurance to cover your medical bills. With an estimated 1 in 8 drivers on the road completely uninsured, this is your shield against the irresponsibility of others. It covers your medical bills, lost wages, and pain and suffering. Don't even think about skipping it. By taking 10 minutes to understand this single page, you've just armed yourself with more knowledge than half the people shopping for insurance. You now know your exact starting point. You know what you have, what it means, and you can start to see where you might be underprotected or overpaying. This is the foundation for everything that comes next. So let's talk about the very first and arguably the most important thing you need to know: liability insurance isn't for your car. Let me say that again. The liability coverage on your auto insurance policy has almost nothing to do with protecting your vehicle. It's about protecting everything else you own: your savings account, your home, your future paychecks. It is a financial shield designed to stand between you and total ruin. And most people get it catastrophically wrong. They see it as a legal nuisance, a box to check to stay on the right side of the law. They ask their agent, "What's the bare minimum I need to be legal?" And they feel smart, like they're saving money. But what they're actually doing is buying a lottery ticket for financial disaster. And the odds are not in their favor. Let me tell you a story about a guy we'll call David. David is a good guy. Works in IT, saves a little for retirement, just bought his first condo. He's responsible. When he bought his newish Honda Civic, he shopped around for insurance. He saw that his state required a minimum of 25/50/25 in liability coverage. That's $25,000 for bodily injury to one person, $50,000 total for bodily injury per accident, and $25,000 for property damage. He thought, perfect. I'm a safe driver. I'll take the state minimum and save $80 a month. He felt like he just hacked the system. For 2 years he did. He paid his premium, drove to work, and that $80 a month went towards a new TV and a weekend trip. He never thought about his insurance again. Until a rainy Tuesday afternoon. He was driving home a little tired. He was stopped at a red light behind a line of cars. His phone buzzed. A text from his wife. He glanced down for just 1 second. That's all it took. In that 1 second, his foot eased off the brake, and his Honda rolled forward at maybe 3 miles per hour, bumping the car in front of him. A classic fender bender. No big deal, right? Wrong. The car he tapped was a brand new Lexus SUV. The driver, a woman in her late 40s, got out, rubbing her neck. The Lexus didn't look too bad, just a scratch on the bumper. David apologized profusely. They exchanged information. He called his insurance, reported the minor accident, and figured they'd take care of the bumper and that would be the end of it. The first sign of trouble came a week later. The estimate for the Lexus bumper wasn't just a few $100s. Because of the parking sensors, the backup camera, the specialized paint, and the labor rates at a certified Lexus dealership, the bill to repair the bumper was $9,000. Okay, David thought, a little steep, but that's what insurance is for. His $25,000 property damage limit would easily cover it. But then the second call came. This one wasn't from his insurance company. It was from a law firm. The woman in the Lexus was now experiencing severe neck and back pain. She had seen a doctor, then a specialist, then a chiropractor. She was claiming she couldn't work. The initial medical bills were already pushing $30,000, and they were just getting started. Suddenly, David's world tilted on its axis. His bodily injury limit was $25,000 for a single person. The medical bills had already surpassed that before a lawsuit was even filed. His insurance company told him, "David, we will pay out your policy limit of $25,000 towards her medical bills. The rest is on you." And the rest was a terrifying, ever-growing number. The woman's attorney sent a demand letter. They weren't just asking for the medical bills. They were asking for pain and suffering, lost wages, future medical costs. The total demand was for $250,000. David's insurance company paid their $25,000 and washed their hands of it. They fulfilled their legal contract with him. Now David was alone, facing a $225,000 demand. The lawyer for the other driver was polite but firm. They knew David had just bought a condo. They knew he had a job. They pulled his public records. They knew he had assets. They told him they could settle, or they could sue him, get a judgment, and then begin the process of garnishing his wages and putting a lien on his condo. For the next 10 years, a portion of every single paycheck David earned would go to pay for that 1 second he looked at his phone. His plans of saving, of investing, of upgrading his home, they were all gone. Wiped out by a 3-mile-per-hour tap on a rainy Tuesday. All because he tried to save $80 a month. This story isn't an exaggeration. It happens every single day in every single state. People anchor on the state minimums without realizing those minimums were often set decades ago, when a new car cost $5,000 and a hospital stay was a fraction of what it is today. That $25,000 property damage limit that sounded reasonable in 1995 won't even cover the cost of a new Ford F-150 today, let alone a Tesla or a BMW. One multi-car accident, one slide on a patch of ice, and you could be responsible for totaling 2 or 3 vehicles. That's $100,000 in damage before you even begin to think about injuries. And the bodily injury limits are even more dangerous. A single broken bone, an ambulance ride, an MRI, and a few days in the hospital can easily exceed a $50,000 limit. If you cause an accident that injures a family of 4, your state minimum coverage might be exhausted before the first person is even out of the emergency room. So what is the real purpose of liability insurance? It is to create a buffer, a firewall. It's a pile of the insurance company's money that stands in front of your money. When you get sued, you want that pile to be as big as possible. You want the other party's lawyer to look at your policy limit and say, "Okay, that's a big enough number. We can settle for that." It's not worth the time and expense to go after the driver's personal assets. Your liability limits are not for you. They are for the lawyers on the other side. You are signaling to the world how much you are worth suing for. With low limits, you are an easy target. The insurance company pays the small limit, and the lawyers come after you for the rest. With high limits, you become a harder target. The lawyers will almost always take the guaranteed payday from your insurance company, rather than chase you for years. So what's the right number? For the vast majority of people, the absolute minimum you should even consider is 100/300/100. 100,000 for bodily injury per person, 300,000 total per accident, and 100,000 for property damage. The jump in cost from the state minimum to this level of protection is often shockingly small. We're not talking about hundreds of dollars a month. Sometimes it's as little as $20 or $30. It is the single highest value purchase you can make in your financial life. For the price of a few fancy coffees, you are buying hundreds of thousands of dollars of protection for your entire future. And if you have a house or significant savings or a good income, you need to think even bigger. You need to look at limits of 250/500/100, and then, on top of that, you need to learn about the single most powerful and misunderstood tool in all of personal finance, the personal umbrella policy. But that's a secret weapon we'll save for a bit later. For now, the lesson is this. Stop thinking about liability insurance as a chore. Start thinking of it as a fortress. It's the wall you build around everything you've worked for, and everything you will ever work for. Before you compare a single quote, you must first decide how high you need to build that wall. Don't let a state government that hasn't updated its laws in 30 years decide for you. Look at the price of cars on the road. Look at the insane cost of healthcare. Make an informed decision to protect yourself. Now that you understand how to build a fortress to protect you from claims made by others, we need to talk about the other side of the coin. What happens when your own car is damaged? What are you actually buying when you add collision and comprehensive coverage? And how can you be sure you're not getting completely ripped off on the deductibles? That's where the math gets really interesting. Let's start with the basics. Collision and comprehensive are the two coverages that actually pay to fix or replace your car. Think of them as two different shields protecting your vehicle. Collision coverage is exactly what it sounds like. It pays for damage to your car when you collide with another object, be it another car, a guardrail, a telephone pole, or even if you flip your vehicle. It doesn't matter whose fault it is. If you back into a parking garage column, that's a collision claim. If someone runs a red light and T-bones you, that's also a collision claim. It's the coverage that handles the physical impact. Comprehensive coverage, on the other hand, is a bit of a misleading name. It's not comprehensive in that it covers everything. It's better to think of it as the act of God and other weird stuff coverage. It handles damage to your car from almost anything other than a collision. A tree branch falls on your hood during a storm? That's a comprehensive claim. A rock flies up from the highway and cracks your windshield? Comprehensive. Your car gets stolen? Comprehensive. Hail damage that makes your roof look like a golf ball? You guessed it, comprehensive. Vandalism, fire, flooding, even hitting a deer. It all falls under this shield. So you have two shields, one for crashes, one for everything else. Now, here's where the money comes in and where most people make a huge mistake. Both of these coverages come with a deductible. The deductible is the amount of money you have to pay out of pocket for a repair before your insurance company pays a single dollar. It is your share of the cost. If you have a $500 deductible and you get into an accident that causes $3,000 worth of damage, you pay the first $500. Your insurance company then picks up the remaining $2,500. If the damage is only $400, you're on your own. Your insurance doesn't get involved because the cost is less than your deductible. This is the fundamental trade-off in car insurance. You can choose a low deductible, say $250, but your monthly premium will be higher. Or you can choose a high deductible, like $1,000 or even $2,000, and your monthly premium will be lower. This is where the insurance companies present you with a choice that feels like a gamble, and they are counting on you to make the wrong one for your financial situation. Let's do the math they hope you won't. Imagine you're looking at two options. Option A has a $500 deductible and costs $150 per month. Option B has a $1,000 deductible and costs $125 per month. By choosing the higher deductible, you save $25 a month. That sounds pretty good, right? Over a year, that's a $300 savings. You feel smart. You feel like you've just hacked the system. But what did you really do? You made a bet. You bet the insurance company $300 a year that you won't get into an accident. And if you lose that bet, the price is steep. The difference between the two deductibles is $500. So, if you get into a single at-fault accident, you have to immediately shell out an extra $500 that you wouldn't have had to with the other plan. Let's look at the break-even point. Your annual saving is $300. The extra cost if you have a claim is $500. To make back that extra $500 risk you took on, you would need to go 20 months, almost 2 full years, without a single claim just to break even on that one decision. Are you willing to take that risk to save 82 cents a day? For some people, the answer is yes. For most, it's a trap. This leads us to the single most important rule for choosing your deductible, and it has nothing to do with your driving record. It's the emergency fund rule. Your deductible should never be higher than the amount of cash you have readily available in an emergency savings account. Read that again. Your deductible is not a theoretical number. It is a promise. It is a check you are promising your future self you can write at a moment's notice on what will probably be one of the worst days of your year. If you choose a $1,000 deductible to save $25 a month, but you don't have $1,000 sitting in a bank account that you can access without going into debt, you haven't bought insurance. You've bought a financial landmine, because when that accident happens, you'll be scrambling. You'll have to put the repair bill on a high-interest credit card, effectively wiping out years of those premium savings in a single interest payment. Or worse, you won't be able to afford the repair at all, and you'll be stuck with a damaged car you can't drive. The insurance company is more than happy for you to choose that high deductible. Why? Because they know human psychology. They know that if you have a $1,000 deductible, you are far less likely to file small claims. That $800 bumper scratch? You'll probably just live with it or pay for it yourself. It saves them a fortune not just on the payout, but on the administrative costs of processing the claim. You're paying them every month for coverage that you're psychologically discouraged from ever using. So how do you choose? It's simple. Open your banking app right now. Look at your savings. What is the amount of money you could withdraw tomorrow for a car repair without breaking a sweat? Is it $500? Is it $1,000? Is it $250? That number is your maximum deductible. Do not choose a deductible higher than that number, period. If you can only comfortably afford to pay $500 out of pocket, then a $500 deductible is the right choice for you, even if it costs a bit more each month. That extra cost isn't waste. It's peace of mind. It's the price of turning a potential financial catastrophe into a manageable inconvenience. And one final pro tip on this. Collision and comprehensive deductibles don't have to be the same. Statistically, you are far more likely to have a collision claim than a comprehensive claim. So, if you want to fine-tune your policy, you could consider keeping your collision deductible lower, say $500, because that's a more probable event, and raising your comprehensive deductible to $1,000 to save a little money, since a total theft or major hailstorm is less likely. It's a way to strategically manage your risk. Okay, so you've figured out how to protect your own car. You've done the math, you've checked your emergency fund, and you've set your deductibles to a level you can actually afford. You feel prepared. You feel secure. But all of this assumes one critical thing. That when trouble happens, it's either your fault or an act of God. But we live in the real world. A world where, according to the Insurance Research Council, 1 in every 8 drivers on the road with you right now is completely uninsured. What happens when they plow into your brand new car at an intersection, and they have no insurance, no money, and nothing to lose? Suddenly, your responsible planning might not be enough. That's when your policy needs to be more than a shield. It needs to be a fortress. And building that fortress requires 2 of the most misunderstood and vital coverages you can buy. I'm talking about bodily injury liability and property damage liability. And if you think those sound boring, I need you to listen closely, because understanding them is the single most important financial decision you will ever make regarding your car. These 2 coverages are not for you. They don't fix your car. They don't pay your medical bills. They do something far more important. They protect everything you own, everything you earn, and everything you will ever earn in the future from being taken away from you in a lawsuit. They are the foundation of your fortress. Let's start with the basics. Property damage liability pays for damage you cause to other people's property. Think cars, but also think bigger. Mailboxes, fences, storefronts, fire hydrants, city light poles. Bodily injury liability pays for the medical expenses, lost wages, and pain and suffering of people you injure in an accident. This is the one that can reach terrifying astronomical numbers. Now, every state, except for a couple of oddballs, requires you to have a minimum amount of this liability coverage. And this is where millions of good, well-intentioned people make a catastrophic mistake. They see the word state minimum and assume it's a recommendation. They think, If it's good enough for the government, it's good enough for me. This is a financial landmine. State minimums are not a recommendation. They are the absolute lowest, thinnest, most pathetic level of coverage you can legally have to be allowed on the road. They are designed to protect other drivers from you, not to protect your financial future. In many states, the minimum property damage limit is just $10,000 or $15,000. Think about that. The average price of a new car in America is pushing $50,000. If you cause an accident that totals just one average new car, a $15,000 policy doesn't even cover a third of the cost. The rest? That comes from you. But let's make this real. Forget statistics. Let's talk about Mark. Mark is 35. He's a good guy. Has a decent job in IT, a small but growing 401k, about $15,000 in savings, and he just bought his first condo. He's building a life. He's a safe driver. No accidents on his record. When he shopped for insurance, he saw he could save about $40 a month by choosing his state's minimum coverage, 25/50/25. That means his policy will pay up to $25,000 for injuries to one person, a maximum of $50,000 for injuries to everyone in the accident combined, and $25,000 for property damage. He thinks, $40 is $40. I'm a safe driver, I'll take the savings. It's a bet he makes every month. A bet on his own perfection. One Tuesday afternoon, he's driving home. He stopped at a red light. His phone buzzes. It's a text from his boss. He glances down for 2 seconds. Just 2 seconds. In that instant, the light turns green, the car in front of him starts to go, but then suddenly stops for a pedestrian. Mark's foot is already moving from the brake to the gas. He looks up, but it's too late. He plows into the back of a brand new Lexus SUV. The impact shoves the Lexus into the intersection, where it's T-boned by a plumber's van. Mark is fine. His airbag deployed, his 10-year-old sedan is totaled, but he's okay. But the world outside his car has just ended his financial life as he knows it. The Lexus, valued at $75,000, is a complete loss. The plumber's van has over $15,000 in damage, and all the specialized equipment inside is ruined. The total property damage is over $90,000. Mark's policy limit is $25,000. Before anyone even talks about injuries, Mark is already personally on the hook for $65,000. His entire life savings is gone, and he's still $50,000 in debt. But it gets so much worse. The driver of the Lexus is a surgeon. She suffers a severe back injury. She needs surgery, months of physical therapy, and she can't work for at least a year. Her initial medical bills are $120,000. Her lost income for that year is over $400,000. Her husband, in the passenger seat, has a broken wrist and a concussion. His medical bills are $30,000. The plumber driving the van has 2 broken ribs and whiplash. His bills are another $20,000. Plus he's losing money every day his van is out of commission. Let's add it up. The total for bodily injuries is well over $500,000. Mark's policy limit for bodily injury is $25,000 per person and $50,000 total for the whole accident. His insurance company writes a check for $50,000 and wishes him the best of luck. They fulfilled their legal obligation. They are done. Now the lawyers get involved. The surgeon's insurance company, her disability insurer, and her personal injury attorney come after Mark. They sue him for the difference. The $500,000 medical bills and lost wages, plus pain and suffering, which can be multiples of that. They get a judgment against him for $1 million. What happens now? Mark's $15,000 in savings is gone. The court orders a lien on his new condo, so when he sells it, they get the proceeds. And then the final nail in the coffin: wage garnishment. For the next 20 years, a quarter of every single paycheck Mark earns is automatically deducted and sent to the people he injured. Every raise he gets, every promotion, every bonus, a huge chunk is gone before he ever sees it. That $40 a month he saved has now cost him his home, his savings, and a quarter of his income for the next 2 decades. He didn't just have a car accident. He was sentenced to a lifetime of financial servitude. All because of a 2-second glance at a phone and a bad decision he made years earlier to save the cost of a few cups of coffee a month. This isn't a scare tactic. This exact scenario plays out in courtrooms across America every single day. So what's the answer? How do you build the fortress? You increase your liability limits. You increase them to a level that protects your actual net worth and your future earning potential. For most middle-class Americans, the absolute bare minimum you should even consider is 100/300/100. That's $100,000 per person, $300,000 per accident for injuries, and $100,000 for property damage. This would have completely covered the property damage in Mark's accident and would have provided a much stronger defense for the injury claims. But the real sweet spot for most people is 250/500/100. Why? Because these are often the minimum underlying limits required to purchase the ultimate weapon in asset protection: an umbrella policy. An umbrella policy is an extra layer of liability coverage, usually for $1 million or more, that sits on top of your auto and home insurance. It's the watchtower on top of your fortress, protecting you from those truly catastrophic, black swan events. And here's the most important part, the secret that insurance companies don't exactly advertise. Increasing your liability limits is the cheapest, most cost-effective upgrade you can make to your policy. The jump from a pathetic state minimum policy to a robust 100/300/100 might only be $15 or $20 a month. The jump from there to the 250/500/100 that qualifies you for an umbrella policy might be another 10. We are talking about the price of a Netflix subscription to protect your entire financial future. You will spend more on coffee this week than the cost of upgrading from a paper shield to a stone fortress. So when you're comparing quotes, don't just look at the bottom line price. Look at the liability limits. Don't start with the state minimum and ask, how much cheaper can I get it? Start with robust limits like 100/300/100 and ask, how can I get this level of protection for the best price? It's a complete reversal of the typical shopping process. And it's a change in mindset that separates financially savvy people from future victims like Mark. You're not just insuring your car. You're insuring your ability to build wealth, to own a home, to send your kids to college, to retire with dignity. Don't ever let that be the thing you try to save a few bucks on. But even with the right liability limits, there's another hidden trap. A detail in the policy that can leave you stranded and paying thousands out of pocket, even if the accident isn't your fault. That trap is called the uninsured motorist gap. And it's a chasm that millions of well-meaning drivers fall into every single year. Let me paint you a picture. Imagine you're driving home, you're stopped at a red light, minding your own business, maybe singing along to the radio. Suddenly, bam, you get rear-ended. Hard. Your neck is throbbing, your new car's trunk is now sitting where the back seat used to be. The other driver gets out, apologizes profusely, but then he drops the bomb. I don't have insurance. I lost my job, I let it lapse. In that single moment, your world turns upside down. Who pays for your hospital visit? Who pays for your totaled car? You weren't at fault. Seems insane that this should be your problem. You might think, well, I have great insurance. The good hands people or the friendly neighbor company, they'll take care of it. But here's the terrifying truth. Your standard liability insurance, the coverage we just spent all that time talking about, does absolutely nothing for you in this situation. Zero. Liability coverage pays for the damage you caused to other people. It doesn't cover your car or your own medical bills. So what happens? You could try to sue the other driver personally. Good luck with that. If they can't afford a $100 a month insurance premium, do you really think they have $50,000 sitting in a bank account to cover your new car and your medical bills? The reality is you'll spend a fortune on lawyers to chase a ghost, and you will likely never see a dime. This is the uninsured motorist gap. And it is precisely why the second non-negotiable pillar of your insurance policy is uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. This isn't an upsell. It's not a luxury add-on. It is your financial body armor against the 1 in 8 drivers on the road right now who are illegally driving without any insurance whatsoever. Think about that. On your average commute, you will pass dozens, maybe hundreds of cars. Statistically, a significant number of them are rolling liabilities, one mistake away from causing financial ruin for someone like you with absolutely no way to pay for it. Uninsured motorist coverage steps in and acts like the insurance the other driver should have had. It has two parts. The first is uninsured motorist bodily injury, or UMBI. If an uninsured driver hits you and you're injured, this coverage pays for your medical bills, your lost wages from being out of work, and even for things like pain and suffering. It protects your health and your ability to earn an income. The second part is uninsured motorist property damage, or UMPD. This pays to repair or replace your car. It makes you whole again. But it gets even more complicated and frankly more common. What about the driver who isn't uninsured, but underinsured? This is the UIM part of the equation, and it might be even more important. Millions of people, in an attempt to save money, only buy the absolute bare minimum insurance required by their state. And those state minimums are terrifyingly low. In some states, you're only required to carry $10,000 or $15,000 in property damage liability. Let's think about that. The average price of a new car in the United States is now over $48,000. Do you see the problem? Let's say you're driving your brand new $40,000 SUV, and someone runs a stop sign and T-bones you. Your car is totaled. The at-fault driver is a good person, they did the right thing, they have insurance. But they only have the state minimum coverage of, say, $15,000. Their insurance company will write you a check for $15,000, wish you the best of luck, and that's it. They have fulfilled their legal obligation. You are left with a $15,000 check and a $40,000 pile of scrap metal. You are still on the hook for the remaining $25,000. Where does that money come from? Out of your savings? Your kid's college fund? This is where underinsured motorist, or UIM coverage, becomes your absolute hero. Covers that gap. In that scenario, your own UIM policy would kick in and pay that extra $25,000 to make you whole. It fills the gap between the other driver's pathetic coverage and the actual cost of your damages. Now, I know what some of you are thinking, but I have good health insurance and I have collision coverage on my car. Isn't that enough? Why should I pay extra for UM/UIM? This is the most common and the most dangerous misconception about car insurance. It's a line of thinking that has led countless people to financial disaster. Let's break it down. First, your health insurance. Yes, it will help with medical bills, but it comes with deductibles you have to pay first, sometimes thousands of dollars. It has copays for every visit and prescription. It might not cover certain specialists or treatments. And most importantly, your health insurance will not pay you a single penny for the wages you lose while you're recovering and can't work. It won't compensate you if you suffer a permanent injury that impacts your quality of life. UM bodily injury coverage can do all of that. It's designed specifically for the full spectrum of costs associated with a car accident injury. Second, your collision coverage. Yes, if an uninsured driver hits you and you have collision, your insurance company will pay to fix your car. But here's the catch. You have to pay your deductible first. That's usually $500 or $1,000 out of your pocket right away, for an accident that wasn't even your fault. And even worse, depending on your company and your state, a claim on your collision policy, even when you're not at fault, can sometimes be viewed as a negative mark on your record, potentially leading to higher rates down the line. However, if you use your uninsured motorist property damage coverage instead, the deductible is often much lower, sometimes zero. And because you are explicitly not at fault, it has no negative impact on your future premiums. It is the cleaner, cheaper, and smarter way to fix your car. And there's one more scenario where UM coverage is the only thing that can save you. The hit and run. It's the ultimate nightmare. Someone smashes into your car in a parking lot and takes off. Or worse, they clip you on the highway at night and just keep going. In that situation, because you can't identify the other driver, they are considered uninsured by default. If you don't have uninsured motorist coverage or collision, you are 100% on your own. Your insurance company will not pay a dime. The entire cost to repair your car comes directly out of your bank account. So how much of this coverage do you need? The answer is simple, and it is critical. You should have UM/UIM limits that are identical to your own bodily injury and property damage liability limits. Let me repeat that. Match your UM/UIM limits to your liability limits. The logic is undeniable. You chose your liability limit, say 100/300/100, because you determined that's how much you need to protect your own assets if you cause a serious accident. That's the value you placed on protecting your house, your savings, your future. So, why on earth would you give yourself less protection against someone else's irresponsibility? If your financial life is worth protecting to the tune of $300,000, then your physical health and your own property should be worth protecting to that same amount. You are essentially insuring yourself against the worst-case scenario with the same diligence you use to insure others against your own mistakes. When you get a quote, the system will often default to the state minimum, or a very low number for UM/UIM. You have to be proactive and raise it to match your liability. The cost to do this is usually surprisingly small, maybe a few extra dollars a month, but the level of protection it provides is monumental. Don't let an insurance agent or a website talk you out of it. Don't sign the waiver form to reject it just to save $6 on your monthly bill. That $6 could be the most expensive money you ever save. Because the moment you need it and don't have it, you'll realize you traded a shield that could have saved your family's financial future for the price of a fancy cup of coffee. So you've got your liability right, you've got your UM/UIM in place, you think you're covered. But there's one more piece of the puzzle, a type of coverage that most people think they have, but the fine print reveals a devastating exclusion that could cost you your car entirely. It all comes down to two little words on your policy: actual cash. Those two words are printed on almost every standard auto insurance policy in America, and they are the reason why full coverage is one of the most dangerously misleading phrases in the entire insurance industry. Sounds so safe, so complete. You hear full coverage, and you imagine a golden shield protecting your brand new car from anything the world can throw at it. You think that if your car is stolen or crushed by a tree, or totaled in an accident, the insurance company will simply write you a check for what you paid, or at the very least what you still owe on it. But that's not what actual cash value means. Not even close. Let me tell you about a guy named David. David was a contractor, a hardworking guy who finally saved up enough to buy his dream truck. A 3-year-old, low-mileage, fully loaded Chevy Silverado. It was perfect. He paid $42,000 for it, putting a decent chunk down and financing the rest. He called his insurance agent and said the magic words, "I need full coverage." The agent set him up with liability, collision, and comprehensive. David saw his $600 deductible and felt secure. He was paying a hefty premium every month, but for his dream truck, it was worth it. For 18 months, everything was great. The truck was his mobile office, his weekend family hauler, and his pride and joy. Then one evening, a distracted driver ran a red light and T-boned him right in the passenger side door. Thankfully, David walked away with just bruises, but his truck was a mangled wreck. The frame was bent, the airbags deployed, it was an undisputed total loss. After the shock wore off, David wasn't too worried. He had full coverage. He started looking online for a replacement truck, assuming he'd get a check for the 42 grand he paid, minus maybe a little for depreciation and his deductible. He still owed $31,000 on his loan, so he figured he'd have about $10,000 left over for a down payment on a new one. A week later, the call from the insurance adjuster came. The adjuster was polite, professional, and delivered the news that financially crippled him. The actual cash value of his truck at the moment of the accident, she explained, was $28,000. After his $600 deductible, they were sending him a check for $27,400. David was speechless. He owed $31,000. The insurance company was offering him $27,400. Not only was he not getting a $10,000 down payment, but the insurance check wasn't even enough to pay off his loan. He was going to have to write a personal check for $3,600 to his lender, just to be free of the debt on a pile of scrap metal that used to be his dream truck. He had no truck and he was thousands of dollars in the hole. How is that full coverage? It's because of actual cash value. ACV is not what you paid for the car. It's not the replacement cost. It is what your exact car, with its specific mileage, options, and condition, was worth in the open market 1 second before it was destroyed. Insurance companies use massive databases to determine this. They look at what similar trucks are selling for at dealerships and in private sales in your specific zip code. They adjust for your truck's higher than average mileage. They factor in the door ding it had before the accident, the worn tires, the little stain on the passenger seat. They depreciate the value with cold, hard data. And a car, especially a new or nearly new one, depreciates like a rock falling off a cliff. The moment you drive it off the lot, it can lose 10 to 20% of its value. After a year or two, that number can be 30 or 40%. David's mistake wasn't getting full coverage. His mistake was not understanding what those two little words, actual cash, really meant, and not buying the one thing that could have saved him. And that thing is called gap insurance. Guaranteed asset protection, or gap insurance, is one of the most important and most overlooked coverages you can buy, especially if you are financing or leasing a vehicle. It's not standard. You have to ask for it. And it does one simple, beautiful thing. It pays the gap between what your car is worth, the actual cash value, and what you still owe on it. Let's rewind David's story. Imagine when he bought the truck, his insurance agent had asked, "David, you're financing this. For an extra $8 a month, do you want to add gap coverage?" In this alternate reality, David says yes. Now fast forward to the accident. The adjuster still calls and says the truck's ACV is $28,000. His collision coverage still pays out $27,400 after the deductible. But now the magic happens. That check goes to the lender. The lender sees there's still a $3,600 balance on the loan. So the gap insurance kicks in and pays that remaining balance directly to the lender. The loan is satisfied. It's gone. David is at zero. He doesn't have a truck, but crucially, he also doesn't have any debt. He is financially whole, free and clear to go out and get a new vehicle without being chained to the ghost of his old one. For the price of 2 cups of coffee a month, he could have avoided a financial nightmare. So, if you are financing or leasing your car, you need to stop what you're doing right now, find your policy and see if you have gap coverage. If you don't know, call your agent. If you don't have it, get it. Especially if you put little or no money down, or if you have a loan term longer than 4 years, because that's when you are most likely to be upside down, owing more than the car is worth. But what if you own your car outright? What if you have a special vehicle like a classic Mustang you restored yourself, or a highly modified Jeep, or an exotic sports car? For you, actual cash value is an even bigger enemy. An adjuster looking at a 1967 Mustang might just see an old car and offer you a few $1,000s, completely ignoring the $30,000 you put into the engine and restoration. An adjuster doesn't care that you spent 10 grand on a lift kit, new wheels, and a winch for your Jeep. To them, those are just modifications that can sometimes even lower the market value. For these situations, there's a different solution. It's a type of policy that gets rid of the words actual cash value entirely and replaces them with 2 much better words: agreed value. An agreed value policy is exactly what it sounds like. When you start the policy, you and the insurance company agree on exactly what your special car is worth. You might need to provide a professional appraisal or detailed receipts, but you lock in a number. Let's say you agree your restored Mustang is worth $60,000. That number is written into the policy. If the car is stolen or totaled 2 years later, it doesn't matter what the market value is. It doesn't matter what other Mustangs are selling for. The insurance company writes you a check for $60,000, minus your deductible. Period. No negotiation, no depreciation, no hassle. It is the only way to truly protect the investment you've made in a unique or classic vehicle. Now be very careful here. There is a sneaky cousin to agreed value called stated value. And some agents might try to sell you this as if it's the same thing. It is absolutely not. A stated value policy sounds good, but the fine print is a killer. It says the insurer will pay the lesser of the stated value, or the actual cash value at the time of the loss. All a stated value does is set a maximum ceiling on what the insurance company will ever pay, while giving them full permission to pay you less if the ACV is lower. It's a heads they win, tails you lose situation. You want agreed value, not stated value. So now you know how to protect the actual metal, glass, and rubber that makes up your vehicle. You know the secret language of actual cash value, and how to defeat it with gap insurance or agreed value. You're equipped to make sure that if your car is taken from you, you are made financially whole for that loss. But protecting your car is, believe it or not, the small stuff. It's secondary, because your car is replaceable. What isn't replaceable is your financial future. And the single biggest threat to that future isn't the risk of totaling your car. It's the risk of a simple, everyday accident turning into a multi-million-dollar lawsuit. A lawsuit that can completely ignore the value of your car and come after your house, your savings, your investments, and every dollar you will ever earn for the rest of your life, unless you have one specific type of protection that most drivers have set terrifyingly low. This protection is your liability coverage. And it is, without a doubt, the single most important part of your entire auto insurance policy. It's the one part that has absolutely nothing to do with protecting your car, and everything to do with protecting your entire financial life. When you see those numbers on your quote, they're usually written as a series of 3 separated by slashes. Something like 25/50/25. It looks like a secret code, but it's the code that determines whether you walk away from a bad accident, or whether that accident follows you, haunting you for the rest of your days. Let's break it down. That first number is your bodily injury liability limit per person. The second number is your bodily injury liability limit per accident. And the third is your property damage liability limit per accident. Bodily injury is for medical bills, lost wages, and pain and suffering for people you injure. Property damage is for fixing or replacing their car, or their fence, or their storefront, or whatever else you hit. This is the coverage that is legally required in nearly every state. And that's the trap. Because the government sets a minimum level of coverage you're required to have, millions of people assume that the state minimum is enough. They think, if it's good enough for the government, it's good enough for me. This is one of the most dangerous financial mistakes a person can make in the United States. State minimums are not designed to protect you. They are designed to provide a tiny token amount of protection for the person you hit, just enough to keep the system from completely collapsing. The state minimums in many places haven't been seriously updated in decades. They're a joke, a terrifyingly unfunny joke. In some states, the minimum property damage liability is just $5,000. $5,000. Can you even buy a reliable used car for that anymore? Let alone replace the brand new SUV you just totaled? In many states, the bodily injury minimum is only $25,000 per person. Let me put that in perspective. A single ambulance ride with a few basic tests in the emergency room can easily exceed $10,000. A broken leg requiring surgery? You just blew past that $25,000 limit before the anesthesia even wore off. A serious head or spine injury? We're talking hundreds of thousands, if not millions of dollars in lifetime care. And your insurance company will only pay up to your limit. Every single penny beyond that? That's on you. And that's when the lawyers get involved. That's when they look past your totaled car and see your paycheck. They see the equity in your home. They see your retirement account, your kids' college fund, and they see a court order to garnish your wages for the next 30 years. A single mistake, a moment of distraction, can trigger a lifetime of financial servitude. To really understand this, let's leave the numbers and tell a story. Let's talk about Mark. Mark is a good guy. He's 35, married, 2 kids, works in IT. He's a safe driver, no accidents on his record. He's trying to be smart with his money, so when he shops for car insurance, he picks the state minimum liability limits of 25/50/25. Saves him about $19 a month. He feels pretty good about it. One Tuesday afternoon, he's driving home from work. He's stopped at a red light behind a brand new Honda Odyssey minivan. His phone buzzes. It's a text from his wife. "Can you pick up milk?" He glances down for 2 seconds, just long enough to type, "Okay." In that exact moment, the light turns green. The minivan in front of him starts to go, but then suddenly stops for a pedestrian. Mark, looking up from his phone a fraction of a second too late, doesn't see it. He hits the minivan. Doesn't even seem that bad. A classic fender bender. Maybe 15 miles an hour tops. But inside that minivan is a family. A dad, a mom, and their 2 young kids in the back. The impact, while not fast, was jarring. The dad, the driver, gets a herniated disc in his back that will require surgery and months of physical therapy. He's a contractor, so he can't work. The mom gets severe whiplash. One of the kids hits their head on the side window, resulting in a concussion and a trip to the ER for a CT scan. The other kid is fine, just scared. Now, let's do the math of Mark's financial ruin. The minivan, being brand new, is declared a total loss. Replacement value, $45,000. The dad's medical bills, including surgery, hospital stay, and rehab, come to $80,000. His lost wages from being unable to work for 6 months add up to another $60,000. The mom's whiplash treatment and physical therapy total $15,000. The child's emergency room visit and follow-up neurology appointments come to $10,000. Let's add it all up. The property damage to the van is $45,000. The total bodily injury damages are $80,000 plus $60,000 for the dad, $15,000 for the mom, and $10,000 for the child. That's a grand total of $165,000 in medical bills and lost wages. The grand total for the entire accident is $210,000. Now let's see what Mark's smart insurance policy covers. His limits are 25/50/25. For the property damage, his policy pays out its maximum of $25,000 for the minivan. The family is still short $20,000 for their vehicle. For the bodily injury, it gets even worse. The dad alone has $140,000 in damages. Mark's policy only pays $25,000 for him, because that's the per-person limit. The mom and the child together have $25,000 in damages. The policy covers that because it's within the $50,000 per accident limit, and also within the per-person limit for each of them. So, the insurance company pays a total of $25,000 for the dad, and $25,000 for the mom and child. That's $50,000 total for bodily injury. The grand total paid by Mark's insurance company is $25,000 for the van plus $50,000 for the injuries. That's $75,000. but the total cost of the accident was $210,000. That leaves a shortfall of $135,000. Who pays for that? Mark does. The other family's insurance company pays to make them whole, and then their lawyers come after Mark with a vengeance for that $135,000. Mark doesn't have that kind of money in the bank, so they sue him. They get a judgment against him. They put a lien on his house. They garnish 25% of his paycheck every single week for years and years to come. Every promotion he gets, they get a piece. His kid's college fund is gone. His retirement savings are gone. His marriage is strained to the breaking point under the financial stress. And it all happened because he tried to save $19 a month. This is not a scare tactic. This exact scenario plays out in courtrooms across America every single day. So what's the answer? You need to raise your liability limits. And here's the secret. It is shockingly cheap to do so. The jump from a disastrous 25/50/25 policy to a much safer 100/300/100 policy might only cost you $10 or $15 a month. The jump to an even better 250/500/100 might be another $10 on top of that. For the price of a few cups of coffee, you are buying a multi-$100,000 force field around your entire financial life. It is the best money you will ever spend. You should carry as much liability insurance as you can reasonably afford. At a minimum, 100/300/100 should be your starting point. If you own a home or have any significant savings, 250/500/100 is a much wiser choice. Protecting other people with high liability limits is the most critical step. But what happens when the tables are turned? What happens when you're the one sitting at the red light, and the person who hits you is just like Mark with a worthless state minimum policy? Or worse, what if they have no insurance at all and just drive away? Now your medical bills are piling up, your car is wrecked, and the person at fault has nothing to give. This scenario is terrifyingly common, and it's why the next type of coverage we're going to talk about is the one that truly protects you and your family from financial ruin. That coverage is called uninsured and underinsured motorist protection, or UM/UIM for short. And I'm going to be blunt. If you only listen to one part of this entire video, make it this one. This isn't just another line item on your policy. This is the financial firewall that stands between your family and a catastrophe caused by someone else's irresponsibility. Let's go back to that nightmare scenario. You're in an accident that's not your fault. The other driver slams into you. You're injured, maybe seriously. Your medical bills are starting to look like a phone number. You can't work, so you're losing income every single day. The person who caused all of this, they either have zero insurance, or they have the absolute bare minimum policy that their state requires, which might only cover a fraction of your costs. So who pays? Without the right coverage, the answer is you. You pay. You drain your savings. You cash out your retirement funds. You might even have to sell your home. All because someone else broke the law or was just plain cheap. This is not an exaggeration. It happens every single day in America. This is where uninsured motorist coverage steps in like a superhero. Think of it this way. UM coverage essentially becomes the insurance the other driver should have had. It's your own insurance company stepping up to pay for your injuries and damages when the at-fault party can't. Let's break it down. There are two main parts. First, uninsured motorist bodily injury, or UMBI. This is the big one. This is what covers your medical expenses. Not just the ambulance ride in the emergency room, but the surgeries, the physical therapy, the follow-up appointments, the medication. It can also cover lost wages. If you're a contractor who can't work for 6 months because of a broken leg, UMBI can help replace that lost income, keeping your family afloat. And critically, it can also cover pain and suffering, which is compensation for the non-economic damages of the accident, the physical pain, the emotional distress, the trauma that follows you long after the bruises have faded. Now let's talk about its equally important twin, underinsured motorist bodily injury, or UIMBI. This one is a little more subtle, but it's just as vital. Underinsured kicks in when the at-fault driver does have insurance, but their policy limits are too low to cover the full extent of your damages. Let's put some real numbers on this. Imagine you're in a serious accident, and your total medical bills and lost wages come to $100,000. The driver who hit you has insurance, which sounds good at first. But you find out they only have the state minimum liability coverage, which in many states is just $25,000 for bodily injury. Their insurance company will cut you a check for that $25,000 and that's it. They fulfilled their legal obligation. So where does the other $75,000 come from? You're still on the hook for it. This is the gap. This is the financial black hole that can swallow people whole. But if you have underinsured motorist coverage, your own policy swoops in to fill that gap. If you had a UIMBI limit of, say, $100,000, your insurance company would cover that remaining $75,000, making you whole again. Without it, you'd be facing a mountain of debt for an accident you didn't even cause. Do you see why this is so critical? The odds of encountering one of these drivers are shockingly high. The Insurance Research Council estimates that about 1 in 8 drivers on the road in the United States is uninsured. That's nearly 13% of people driving around you with absolutely no safety net. And that number doesn't even include the millions more who are underinsured, driving with policies so flimsy they wouldn't even cover the cost of a single major surgery. When you're comparing quotes, you'll see UM/UIM limits displayed just like your liability limits, with 2 or 3 numbers, like 50/100. This would mean you have $50,000 of coverage per person, up to a maximum of $100,000 per accident. My strong recommendation, and the recommendation of virtually every financial advisor, is to set your uninsured and underinsured motorist limits to be at least equal to your own bodily injury liability limits. If you think you're responsible enough to carry $100/300 in liability to protect others, you absolutely need to have that same level of protection for yourself and your own family. Skimping here is like buying a state-of-the-art security system for your house, but leaving the front door wide open. It makes no sense. Now, there's also a property damage component to this. It's called uninsured motorist property damage, or UMPD. This coverage helps pay to repair or replace your car if it's damaged by an uninsured driver. This can be very useful, especially if you don't have collision coverage, which we'll talk about next. In some states, UMPD can also cover the cost of a rental car while yours is in the shop. However, it's important to know that UMPD and collision coverage can overlap. Collision covers damage to your car regardless of who is at fault, even if it's just you hitting a pole. UMPD only applies when an identified, uninsured driver is at fault. Typically, your collision deductible is higher than your UMPD deductible, so having both can still be beneficial. But if you have to choose just one to protect your vehicle, collision is the more comprehensive option. The key takeaway here is that you cannot control the decisions of other drivers. You can be the safest, most defensive driver in the world, and your life can still be turned upside down in an instant by someone who decided that paying for adequate insurance was optional. Your liability coverage protects your assets from others. Your uninsured and underinsured motorist coverage protects your assets, your health, and your family from others. It is the single most important coverage you can buy to protect yourself from financial ruin on the road. So when you're looking at that quote comparison screen, and you see the option to lower your UM/UIM limits to save $12 a month, I want you to remember this conversation. I want you to think about that $75,000 gap. Is saving the cost of a few cups of coffee worth risking a lifetime of debt? Absolutely not. Max out this coverage to a level that you are comfortable with, and at a minimum, match it to your liability limits. It's a non-negotiable part of a truly protective auto insurance policy. We've now covered how to protect yourself financially from the damage you could cause to others, and how to protect yourself from the damage that uninsured or underinsured drivers could cause to you. But there's a whole other category of risk we haven't touched yet. What happens when the damage to your car isn't caused by another driver at all? What about theft, fire, vandalism, or a deer jumping out in front of you on a dark road? And what happens if the accident is, in fact, your fault? These scenarios are not covered by liability or UM/UIM. This is where the final 2 major types of coverage come into play, and understanding how they work together is the key to making sure your own vehicle is actually protected. The difference between them is subtle, but it could mean the difference between getting a check for a new car or a bill for a tow to the junkyard. So what is the difference? Let's start with collision coverage. The name tells you almost everything you need to know. This coverage pays to repair or replace your car after it collides with something else. Another car, a telephone pole, a guardrail, a building. Even if you just lose control on an icy road and roll your vehicle into a ditch, that's considered a collision. The key element here is that it's generally related to the act of driving and making contact with an object. Imagine you're at the grocery store on a busy Saturday. You're backing out of a tight spot, craning your neck to see around a giant pickup truck next to you. You think you're clear, you let your foot off the brake, and then you hear it, that sickening crunch of metal on concrete. You just backed into one of those thick pillars in the parking garage. Your bumper is dented, and your taillight is shattered. This is a classic collision claim. Your liability insurance, which we talked about before, does absolutely nothing for your own car in this situation. It's only for the damage you do to others. But your collision coverage? This is its moment to shine. You'll pay your deductible. Let's say it's $500, and the insurance company will cover the rest of the repair bill, whether it's $1,000 or $10,000. Collision is your safety net for your own driving mistakes. But it's also a safety net for other people's mistakes, which is a detail many people miss. What if someone sideswipes you and then speeds off? A hit and run. Their liability insurance should have paid for your damages, but they're gone. Or what if the person who hits you has no insurance at all, or just the bare minimum state-required coverage that isn't enough to fix your brand new SUV? In these cases, you can file a claim under your own collision coverage to get your car fixed quickly, and then let your insurance company go after the other driver to get their money back. Without collision, you'd be stuck either paying out of pocket or trying to sue a ghost. Now let's talk about its partner, comprehensive coverage. This is the one that causes the most confusion, but it's actually pretty simple if you think of it this way. Comprehensive covers almost every other bad thing that can happen to your car that is not a collision. In fact, some insurance companies literally call it other than collision coverage. This is the coverage for the chaos of the world, the things that are completely out of your control. A hailstorm rolls through and turns the hood of your car into the surface of a golf ball? That's a comprehensive claim. A heavy branch from your neighbor's oak tree snaps off in a windstorm and crushes your roof? Comprehensive. You come out of the movie theater to find someone has smashed your window to steal the loose change in your cup holder? Vandalism. A comprehensive claim. Your car is stolen from your driveway overnight? Comprehensive will pay you the value of your car. Floods, fires, riots. All of this falls under the umbrella of comprehensive. But here is the single most important and misunderstood example of all: hitting an animal. You're driving down a country road at dusk, and a deer leaps out in front of you. You slam on the brakes, but it's too late. The impact causes thousands of dollars in damage to the front of your car. Now your brain says, I collided with a deer. But in the world of insurance, this is not a collision claim. It is a comprehensive claim. The logic is that you didn't hit a stationary object due to a driving error. A random, unpredictable event happened to you. This is a huge distinction because claims under comprehensive typically don't raise your rates as much as at-fault collision claims do. Knowing this one little fact can save you a lot of headache and potentially a lot of money. So, you have collision for crashes and comprehensive for chaos. When you're getting quotes, you'll see them listed as two separate options. And here's the thing. If you have a loan on your car or if you're leasing it, you don't have a choice. The bank or leasing company that technically owns the vehicle will require you to carry both coverages to protect their asset. If you own your car outright, you could technically choose to have one and not the other, or neither. But unless your car is worth very little, so little that you could comfortably afford to walk away from it tomorrow if it were destroyed, you almost certainly want both. They are the two halves that make up the shield protecting the value of your vehicle. Now, how does this translate into saving money on your quotes? It all comes down to the deductible. Both collision and comprehensive have a deductible, which is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. These deductibles can range from $0 all the way up to $2,000 or more. And this is where you get to be the strategist. A higher deductible means you're taking on more financial risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is on the hook for more, so they charge you a higher premium. When you're on a quote website, don't just accept the default $50 or $500 deductible. Play with the numbers. See how much your premium changes if you raise your collision deductible from $500 to $1,000. You might save $150 a year. Now ask yourself, is that savings worth the risk of having to come up with an extra $500 if you cause an accident? For some people, absolutely. For others, that $500 is better spent on the premium for peace of mind. And here's a pro tip most people don't even know is possible. You can set different deductibles for collision and comprehensive. They don't have to be the same. Think about your specific situation. Do you live in a quiet, low-crime suburb with a garage, but have a nasty commute through rush hour traffic every day? Maybe a claim is more likely to come from a fender bender than from theft or a falling tree. In that case, you might choose a lower, more manageable $500 deductible for collision, but feel comfortable with a higher, premium-saving $1,000 deductible for comprehensive. You're tailoring your risk. The online quote tools are designed for this. They are your control panel. Use them to fine-tune your policy to match your life and your budget. But there's one final critical piece of the puzzle when it comes to protecting your car, and it's a piece of fine print that has financially ruined people. It's a concept called actual cash value, or ACV. When an insurance company says they will pay to replace your totaled car, they don't mean they're going to buy you a brand new one off the lot. They mean they will pay you your car's actual cash value. The ACV is what your exact car, same make, model, year, features, and condition, was worth in the used car market 1 second before the accident happened. And cars depreciate fast. The moment you drove your new car off the lot, it lost thousands of dollars in value. So let's say you bought a car for $30,000 2 years ago. Today, its ACV might only be $22,000. If that car gets totaled, the insurance company is going to write you a check for $22,000 minus your deductible. Here's where the nightmare begins. What if you still owe $26,000 on your car loan? The insurance company gives you $22,000. You give that to the bank. You are now left with no car, and a $4,000 bill from the bank for a vehicle that no longer exists. This is called being upside down or underwater on your loan, and it is a devastating financial trap. The defense against this is an inexpensive, but incredibly powerful add-on called gap insurance. Gap insurance does exactly what the name implies. It covers the gap between what your car is worth, the ACV, and what you still owe on your loan. In our example, it would pay that extra $4,000 difference, leaving you free and clear of the loan so you can start fresh. If you are buying a car with a small down payment, or rolling old debt into a new car loan, you are at high risk of being upside down. Asking for a gap insurance quote is not just a good idea. It is an absolute necessity. So collision covers crashes. Comprehensive covers chaos. They both have deductibles you can customize to control your premium, and they both pay out based on your car's actual cash value, which can leave you in a tough spot if you're not prepared with something like gap insurance. But knowing all this: liability, medical payments, collision, comprehensive, it all leads to the final, most important question. The one that actually determines the number you see on the screen. How do these companies actually decide what to charge you? It's not random. It's a deeply personal calculation based on a handful of factors you might not even realize they're looking at. And understanding those factors is the final key to unlocking the lowest possible rate. We're about to pull back the curtain on how they price your policy, and one of these factors might genuinely shock you. So let's talk about that scorecard. This is the fifth and final thing you absolutely must understand before comparing quotes. The hidden factors that dramatically influence your price. These are the data points insurance companies use to build a profile of you, to calculate, with unnerving accuracy, the statistical probability that you will cost them money. And the first one, the one that catches almost everyone by surprise, is your credit score. Yes, you heard that right. In almost every state, your credit history is a massive factor in determining your car insurance premium. Now you might be thinking, what on earth does my Visa bill have to do with my driving? And it's a fair question. The answer lies in a mountain of data. Insurers have found a strong statistical correlation between how people manage their finances and how they manage risk on the road. They call it a credit-based insurance score. It's not the exact same as your FICO score, but it's built from the same raw material, your credit report. From their perspective, a person who pays bills on time, manages debt well, and shows financial stability is, statistically speaking, less likely to file claims. They're seen as more responsible overall. Conversely, a history of late payments or high debt can be interpreted as a sign of higher risk, leading to a significantly higher premium. We're not talking about a few dollars here. The difference in premiums between someone with excellent credit and someone with poor credit can be hundreds, sometimes even over $1,000 a year, for the exact same driver in the exact same car with the exact same driving record. This is the single biggest non-driving factor that can inflate your costs, and it's why maintaining good credit is not just about getting a loan. It's about lowering your cost of living across the board. Next up is your address. And I don't just mean living in a big city versus a small town. Insurers drill down to your specific zip code, and sometimes even the census block you live in. They are playing a game of probabilities based on geography. They have data on the rates of theft, vandalism, and accident claims for your specific neighborhood. They know which intersections down the street are the most dangerous. They know the frequency of hailstorms, flooding, or other weather-related claims in your area. You could live in one zip code and pay one rate, then move 2 miles down the road into a different zip code and see your premium jump or fall by 20%. Feels like a lottery, and in a way it is. You're being priced based on the collective history of your neighbors. This is why it is absolutely critical to get new quotes every single time you move. Don't just update your address with your current insurer. That move is a fundamental change to your risk profile, and it's the perfect opportunity to see if another company's data models favor your new neighborhood more than your old ones. Then there's the personal data that feels even more personal. Your occupation and your level of education. Again, this is all about statistics. Actuarial tables show that people in certain professions tend to file fewer claims. For example, engineers, scientists, teachers, and pilots are often considered lower risk. The thinking is that these professions may attract individuals who are more risk-averse or detail-oriented. On the other hand, jobs that involve a lot of driving, high stress, or late hours might be statistically associated with more claims. Your level of education also plays a role. A college degree or a master's degree can often result in a lower premium because, again, large-scale data suggests a correlation with lower risk behavior. Now, whether this is fair is a topic for a completely different debate. But for our purposes today, it's a reality of the pricing algorithm. It's a box that gets checked, a piece of data that gets fed into the machine, and it affects the number that comes out the other end. Another crucial factor is your insurance history, specifically, whether you have maintained continuous coverage. Having a lapse in your auto insurance, even for just a few days, is a massive red flag for insurers. It signals instability and high risk. If you sell a car and plan to buy another one in a month, don't just cancel your policy. Talk to your insurer about a non-owner policy or see what options exist to avoid a lapse. A lapse in coverage can haunt you for years, leading to dramatically higher premiums when you try to get insured again. It can put you in a high-risk category, even with a perfect driving record. On the flip side of this is the loyalty paradox. You would think that staying with the same company for 10 years would earn you the best possible rate, right? Often the opposite is true. This is called price optimization, or, less charitably, a loyalty penalty. Insurers know that customers who don't shop around are unlikely to leave, so they may slowly creep up your rates year after year, knowing you won't notice or bother to check. Meanwhile, they're offering deep, introductory discounts to poach new customers from their competitors. This is the ultimate reason why the advice to compare quotes every year isn't just a suggestion. It is the fundamental rule for not getting taken advantage of in this industry. Your loyalty should be to your wallet, not to a brand that may be penalizing you for it. Finally, let's look at the car itself, but on a much deeper level. You already know a sports car costs more to insure than a minivan, but it goes so much further. They look at the specific trim level of your vehicle. Does it have the V8 engine or the 4-cylinder? Does it have advanced driver assistance safety features like automatic emergency braking and blind spot monitoring? These features can earn you significant discounts. They look at crash test ratings from the Insurance Institute for Highway Safety. A car that protects its occupants well means lower medical claim payouts. But they also look at how well the car withstands low-speed collisions. If a 5-mile-per-hour fender bender on your specific model costs $5,000 to repair because of sensors embedded in the bumper, your collision premium will be higher. They also have incredibly detailed data on theft rates, not just for the Honda Accord but for the 2019 Honda Accord Sport. They know which cars are targeted for their catalytic converters, their airbags, or are just easy to steal altogether. A high theft rate in your area for your specific car will send your comprehensive coverage costs soaring. So let's put this all together. Over this entire journey, we've built a complete blueprint for mastering the world of auto insurance. First, we learned to decode the policy itself, understanding that liability is for them, while collision and comprehensive are for you, and that state minimums are a financial trap waiting to be sprung. Second, we mastered the deductible dance, realizing that choosing a higher deductible is a calculated bet on yourself that can save you hundreds of dollars a year in premiums, as long as you have that amount saved in an emergency fund. Third, we learned to vet the company, not just the price. We now know to look at their financial strength, their customer service track record, and their claims satisfaction, ensuring that the company we choose will actually be there for us when disaster strikes. Fourth, we perfected the art of the comparison, gathering our information, using a mix of tools from independent agents to online aggregators and direct quotes, and ensuring every single quote was a true apples-to-apples comparison of identical coverages. And finally, today, we've pulled back the curtain on the invisible scorecard. We now understand that our credit history, our specific address, our occupation, our insurance history, and the granular details of our vehicle are all being fed into a complex algorithm that determines our price. You are no longer just a driver looking for a policy. You are an informed consumer who understands the entire game. You know the questions to ask, the coverages to select, the companies to investigate, and the hidden factors that shape your rate. You now have the power to not just accept the first quote you're given, but to architect a policy that is tailored to your exact needs at the best possible price. The process is no longer intimidating. It's an opportunity to save hundreds, maybe even thousands of dollars a year. That's money that goes back into your pocket to invest, to save for a vacation, to pay down debt, to work for your goals, not an insurance company's bottom line. Take this knowledge and use it. Set a reminder on your calendar for 6 months from now, or for 30 days before your current policy renews. When that day comes, run the play. Gather your quotes, make your comparisons, and take control of one of your biggest household expenses. You now have everything you need to win.